The Reserve Bank kept the cash rate on hold today at the 12-year high of 4.35%. This was a widely expected decision and comes after RBA Governor Michelle Bullock has said repeatedly this year that rates will need to remain on hold for a while to crush inflation.
Inflation is still above our target and it's proving to be sticky. Progress in getting underlying inflation down has slowed and it's likely to have remained slow in the September quarter. We judge that the level of demand is still above the economy's ability to supply goods and services, but that gap is closing.
The RBA expects inflation to fall sustainably within its target band of 2% to 3% by 2026. The challenge for the Reserve Bank is the mixed economic messages it's reading in Australia. GDP growth in the June quarter was just 0.2%, but the unemployment rate is surprisingly resilient at 4.2%. Government spending is at record levels with cost of living relief and tax cuts being handed out to every Australian, but productivity remains at its lowest level since 2016.
So what does this all mean? Well, the recent data, I think you'd agree, have been a little mixed, but overall they reinforce the need to maintain a restrictive monetary policy stance and remain vigilant to the upside risks to inflation. The board needs to be confident that inflation is moving sustainably towards the target before any decisions are made about a reduction in interest rates.
Ms Bullock says the RBA board did not explicitly consider raising rates at the September meeting. Treasurer Jim Chalmers was asked today about his comments earlier this month when he said interest rates are smashing the economy.
I don't preempt and I don't second guess decisions taken by the Independent Reserve Bank. I've made that very clear repeatedly. I've made a factual statement that the interest rate rises which are already in the system, combined with some of these other factors, are slowing our economy quite dramatically. We saw that in the most recent national accounts.
And here is the Shadow Treasurer, Angus Taylor, talking about the federal government's cost of living relief.
The point here is that the government is attempting to manipulate headline inflation and the Reserve Bank is seeing straight through government manipulation. The government needs to focus on doing the real job, which is to bring core inflation down so that interest rates can come down so Australian standards of living can be restored to where it should be.
For more on this, I'm joined by Paul Bloxham, HSBC Chief Economist for Australia and New Zealand. Paul, the RBA kept rates on hold, no surprises there, but how far away is a cut?
Oh, it's still some time away, I think. I mean, we've had a view all year that we didn't think they're cutting this year. The rate cuts are going to be in 2025, not 2024. And we don't think they're going to come till well into 2025. So our central case is they don't cut until the second quarter of next year, so April or May. And really this reflects what the governor was relaying today and what the RBA was saying, that inflation is proving to be sticky. Core inflation is still holding up at a rate that's uncomfortably high for the RBA. It's not falling very quickly. And it's a complicated thing to explain. Demand has slowed down. You're right, GDP growth has slowed down, the consumer has slowed down and so on. But the supply side of the economy, productivity in the supply side of the economy is so weak that even with that slowdown in demand, it hasn't brought inflation down enough. So we either need to see a longer period of weak demand to get inflation down, which is what we're sort of expecting, or some improvement on the supply side, which we think is going to be quite gradual. So no rate cuts for quite some time yet is our central case.
How hawkish do you think the governor was in her comments today? Was she as hawkish as the previous couple of meetings?
I think what she's tried to explain was that things are basically the same as they were when they met last time.
Yeah.
They said some similar language, but they said they've ruled out near-term interest rate cuts, and keeping in mind that if you move 6 weeks forward and still rule out the near term, that moves the near term 6 weeks forward. So, that's kind of, and they didn't explicitly think about lifting rates today, but as the governor said in the press conference, that's because the frame of the discussion was, are things different to where they were last time around? And they've judged no. They've judged they're basically in the same spot, which means it's still some time, I think, before they were able to cut rates.
Most G10 banks are now cutting rates around the world. Is Australia's RBA becoming a bit isolated amongst its global peers?
We are in a different spot. And we've expected that we would be, but we are in a different spot. Inflation's coming down more slowly. Why is that? So there's a couple of things. The first one is the RBA lifted interest rates by less than everyone else. They lifted interest rates by 425 basis points. Even the governor referred to it today as, well, other central banks are cutting their rates, but they've still got higher rates than we do because they went further on the way up. And so, they lifted rates by more, and they've had, potentially more effect in terms of slowing inflation. And the other thing I think that's really worth bearing out is certainly in comparison to the US, Australia's productivity performance is really quite woeful at the moment. I mean, GDP per hour worked is the same level right now that it was in 2016. But in the US, productivity has actually been picking up. They've had an acceleration in productivity, an upswing. And so they're getting more disinflation. It's happening more easily because they're having an improvement on the supply side of their economy. So we just look very different. We are in a different spot. And so we shouldn't expect the same policy response. I think policy they're not going to be cutting for quite some time.
Yeah, we know economic growth in June quarter was pretty low, but one thing that kept it ticking over was public demand and public spending. I mean, how big a role is that playing in keeping inflation sticky? It
is playing a role in this story because what we've got is the RBA tightening or maintaining tight policy settings to try to get inflation to come down. And at the same time, we've started to see some fiscal loosening. That came through in the budget. It came through in these cost of living measures that were delivered as well. So fiscal policy has started to get looser, just as monetary policy is maintaining how tight it is. And so that is another factor that is likely to mean that inflation proves to be a bit stickier, and in all likelihood, it means that interest rate cuts don't come as soon.
And we've got, obviously, the Queensland election next month, federal election in May. There could even be more cost of living relief on the way, which is obviously great for households, but it does provide a bit of a challenge for the Reserve Bank Board.
Well, if fiscal policy is loosening at the same time that monetary policy is being maintained at a tighter setting to get inflation down, then yeah, the two arms of policy are sort of not working in the same direction. If that plays out for long enough, that will contribute to interest rates not being able to come down for even longer. I guess the most interesting thing is if we get to a point somewhere out in the distance where the RBA has finally gotten domestic inflation down, but the global economy is starting to turn around by that point because all these other central banks around the world are cutting interest rates themselves, will we actually get interest rate cuts at all?
Hopefully that doesn't happen. But the timing of today's meeting is a bit unfortunate because tomorrow the monthly CPI numbers come out. CPI could come in within the target band of 2.2 to 3%. So how does the RBA sort of explain things in 6 weeks' time when they next meet?
I think they tried to explain it today. I mean, if you read the statement that they delivered today, it very, very explicitly, and the press conference, said we're focused on the core measures of inflation, underlying inflation, the trim mean. We're not going to be we're not going to be drawn away from what's going on in the economy by the energy rebates forcing the headline rate of inflation down, which is almost certainly going to happen tomorrow. I mean, the CPI indicator we think will drop to 2.7. That's our forecast year on year. So it would be, comfortably within the target band. But we think the trimmed mean, the measure that the RBA focuses on, will still be running at 3.5. So we're going to get this gap that opens up between headline inflation and core inflation that's going to make it even more difficult to explain why it is the RBA is not cutting rates. But it is clear that they are focused on those underlying measures because they're not going to be distracted by the fact that policy measures are temporarily lowering the headline rate of inflation.
And then in October, there's the retail trade numbers and the quarterly CPI. And I guess the quarterly one is the one the RBA really looks at.
Yeah, the quarterly one's very important. And again, it's the underlying measures of that quarterly measure that they're going to be most focused on. But, tomorrow's release will still have some information in it. But the key thing is focus on the trim mean, focus on the core measures tomorrow. The headline rate is not really where the RBA is focused.
Paul Bloxham, thanks for your time.
Thank you.